Good morning and welcome back to Almus Market Mornings. More recently, we have been discussing about the various diverging views within the Fed. Though it may not have been the exact resemblance to the disagreements one faces while organizing the infamous Goa trip, it does have a certain degree of similarities. Let's take yesterday, for example. Stephen Miran in his speech mentioned the policy is too restrictive. John Williams said the policy positioning is appropriate for next year, while Susan Collins is concerned about higher inflation. This kind of tricky to interpret, especially to determine the next year's rate path. Dollar index broadly trades near the weaker end of the range, but as usual, rupee did not take much inspiration from this. Good morning, JK. What are we expecting from the payrolls data today, and your thoughts on the rupee? I mean, now we are close to 91 against the dollar. Where are we seeing this go?
Good morning, Swaraj. So it's not, it's not very clear where this fall in the rupee is going to stop. What is very clear is the trend is very strong. Almost daily, we are making a new high in the USD INR, and none of the factors are actually helping. Even some of the factors that normally used to help the rupee to recover are not really helping. Like yesterday, for example, we had this trade number from India for the month of November, and that was a big improvement from the month of October, falling from about 41 billion deficit to around 24 billion. And the pleasing part was that while imports declined, which was also a moderation or rather correction of the big gold and silver import, which was seen in the earlier month, exports rose substantially, and even the exports rose in the merchandise side as well. In fact, the net services exports were somewhat modestly lower. So commodities exports have actually rose more than 10% in the month of November, but market totally ignored it, barring a small knee-jerk reaction of about 10 paise. We were once again at the highs in USD INR. So markets focus is definitely not on the normal factors. In fact, even the WPI inflation came once again on the negative side, although slightly less negative, uh, which means the inflation scenario is very much benign, and we know that growth is higher in India. It's such one of the highest levels, and that is not really making any difference to the trend in the rupee, where currently it all boils down to three factors. One is the flow part, which is definitely negative. Yesterday also FIs were selling in stocks, and that would result in outflow of the dollar. Second factor is the trade deal, which continues to elude, and there continues to be a contradictory statements or reports coming about the deal being signed. And thirdly, what the RBI does. And RBI, while we are not seeing too much of intervention from RBI currently, there is also the focus on RBI's buy-sell swap that is likely to happen today, where they would be, buying. They are supposed to be buying back whatever they sold earlier and push it to a further date. So these are the focus of the market and not really on the macro numbers. Macro numbers have been good for quite some time. So I doesn't look, neither there is any change in these negative fundamentals. The market is seized off, nor the technicals that is looking for any reversal. So that's the scenario for the rupee. Just for a record's sake, we rose 6% on year-on-year basis as of yesterday. It is also 8.13% rise from low to the high this year. We have had some larger rises only in 2022, the Ukraine war time, 2018 when the Chinese yuan crisis was there, 2013 when the bond market crisis was there. Other than these, this is one of the this year, which is yet to complete, and we have another 15 days to go, is yet to is one of the highest rises in the dollar rupee that we are seeing. So just to answer your point, there's no change in the trend in the rupee. 91 is not something which is written in stone. It can be breached if the current benign approach of RBI continues, and market continues to hedge the payables. So what is also happening is as we go higher in the spot rate, more and more importers and foreign currency loan holders are drawn into hedging as a matter of risk management. So this has a big, the bar for reversal in the USD INR is very high now. So I think we should contend with weaker rupee for quite some time. In the global market, we have the markets awaiting today's job reports for November. It is a combined report. Rather, we will have the October and November report together. Now, expectation for November is 4.4% unemployment rate to be maintained. Non-farm payrolls expected at 35 to 50,000 versus 1,90,000 in 19,000 in September. Now, these numbers have to be viewed also in the context of higher number of layoffs reported in Challenger report, private payrolls coming at minus 32,000. Jobless claims have risen in the recent week, but again, that's making up for the steep fall in the previous week, and that has been affected by the Thanksgiving holiday, delay in filing. So we normally jobless claims have been in the normal range of about 2,20,000. So whether the impact of the government shutdown, how much it is reflected in the payroll numbers is what the market would be looking at, and whether there is an indication whether sustainable job market decline is on the way or not. This what something market will be looking at. We'll also have the October retail sales, again, indication for the consumption that we'll be looking at, and the preliminary global PMI, S&P Global's PMI also will be looked at. So more focus on US economy now that the rates have reached a level from where next rate cut is the timing of the next rate cut seems to be the most unclear aspect for the market. As I said, most of the Fed members themselves have been talking, quite, I would say quite contradictorily. There was a lot of dovish talk before the Fed meeting, and now most of them are cautious, about moving further on the rates. Even Stephen Miran's statements yesterday were, I thought, less dovish than it usually used to be. So that's the situation. As for the markets, we are, they're biding time for the data, but I think post data also, unless we have a very big deviation from what the markets are expecting, we should see the markets kind of die down without liquidity until the year end. It's not much that we should expect in terms of a trend. And a couple of things, of course, an interesting aspect that's come up is, the NASDAQ has now, filed paper with the US Securities and Exchange Commission for round the clock trading of its stocks, particularly the tech stocks, which they're looking to capitalize on global demand for US securities. An interesting news that was available. Oil prices were hitting multi-month lows, looking to break 60 on the Brent crude. This also coming on the back of intensifying Ukraine peace talks. So statement from European leaders welcoming the significant progress on Trump's Ukraine efforts. So that also gave a push to the oil prices on the lower side. Dollar index continues to trade near 2-month lows as the major currencies of Euro, GBP, and Yen remain strong. Some of the EM currencies actually made new high against the dollar yesterday. And this trend of dollar fall is been, steady. It's not really falling off the cliff, but it's steady. And dollar index is also, trading at the low 98s. Of course, a break of 96, as we have mentioned many times, break of 96 is required for a new big trend of the dollar index on the downside to start. Without that, maybe we are still in the weaker range. And interestingly, today's fixing in Chinese yuan by their central bank at 7.0602 is at a 26-month low. So the steady downtrend in the USD yuan is also continuing. Just to reiterate, none of this is actually impacting our domestic currency, which continues to steadily fall and almost a one-way market. But no, one personal observation is that the market is getting too one-sided. Corporate action is also quite one-sided. We may be just one or two solid good news away from the reversal, but when that will come, and maybe a trade deal, framework trade deal, which some have talked about being near, could be one of them. But keep our fingers crossed on this. Thank you.
Thank you, JK. And yeah, I think those two, three factors that have been affecting the rupee, they continue to sort of drive the sentiment. And as JK mentioned, I think it's more to do with now the weaker sentiment, and we are just, two, three positive developments, and rupee will get some sort of relief. Because globally, we are seeing the contra trend, which is dollar weaken significantly. We are seeing a lot of emerging market currencies appreciate against the dollar. Rupee, as of now, has not participated whatsoever because we are down 6% year on year. So we remain not good performers over there. Job market will be in focus today, October and November report. Remember, the unemployment rate is forecasted for November at 4.4%. This will be closely watched because this would determine the rate path for next year. So that's something that people would be closely watching. That's it from us today. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.